Hi, everyone. Welcome to the stock market update. I hope you've been enjoying the markets and the roller coaster ride that August has brought. I'm back from my various travels and the like, so let's get right into it. There's NVIDIA earnings to discuss as well, isn't there? So we've got sunny Zurich. Let me know where you're from if it's the first time you've been on here as well, and we'll start a poll straight away to just get things rolling. Okay, wonderful to see you on, Stefan from Zurich. We have Nottingham, we have Bedford, we've got the Lakes, and Jack from Clun. I don't know where Clun is. There we go. Now, lots to cover. First things first, please remember this is not financial advice because I don't know you personally anyway, and none of this should be taken as a solicitation to go and buy something. You've got to make your own decisions based on your own risk appetite and your own personal circumstances. Okay, I've been working on this book. It is overdue. Financial Times gave me a contract to write this. They've paid the advance and so on. So I've been working flat out on getting that done, and hope you will be some of the people to buy it in due course. Let's talk about the S&P 500, shall we? The number of stocks outperforming the index as a whole. So if you're wondering if you're not performing the index, of course, the easiest thing to do is then buy the index. But in the third quarter of 2024, 296 stocks beat the index, 128 only in the second quarter. So if in the second quarter you felt, oh God, the index has done better than I have, well, you're in good company because very few stocks did indeed beat the index. And most of the time, by the looks of it, less than 250 do. In other words, it's a minority of companies which move the index, which could be seen as one reason to select the index in your investments, and we'll look at that in a second. But it could also be seen as a reason to be more selective than the index and say, well, actually, there's quite a few that beat the index. Let's pick those individually. We'll delve a little bit deeper into the stocks which look good at the moment in just a second. Welcome, Wokingham. We've got Gummersall. I know Gummersall. I went to Full Net Boys School. Gummersall is right next door. Now, until the summer, the S&P had one of the best starts ever, like ever. This is the S&P 500, the 500 largest US companies, performance since 1928. Look at this year. It was in the top best performing years it's ever had. The average is about here. Okay, that's what it normally tends to do. It's sort of reverting to the mean, but it's been a phenomenal year. My job is not to have known that. I didn't know it was going to be such a great year. My fear was it'd actually be a pretty mediocre year, 0%, maybe even negative returns, given how good last year was. However, my job isn't to try and guess what's going to happen with the market. It's to take advantage of opportunities when they come along, and this year gave opportunities. It also gave a lot of traps. So let's look at that as we go forward to see what we might want to invest in, look at some of the big stocks as well. By the way, I will make sure you all get a downloadable free copy of this book, one of my previous books, Investing Unplugged. Lots of lovely reviews, including from Bernard Opperty, who is the founder of a $2 billion hedge fund, from a colleague of mine at Bloomberg TV, Peter Temple, a colleague from the Financial Times, and so on. So I'll make sure you all get a copy that you can download. In terms of the question, will the FTSE be higher or lower by the year end? You're equally divided between not sure and yes. Interesting. Now let's have a look at, will the Dow be higher by the year end? And we'll have a look at that. Okay, Bonnie, Scotland. It is Bonnie indeed, and so are the people there. And we've got Cardiff. We have got, we just need Belfast in here. And we will have all capitals of the Union covered, all countries of the Union covered. Now, I've been informing and educating people about investing since, well, 1999. This is 1999 when I started writing my weekly column in the Financial Times, The Diary of an Internet Trader. So I would go through my weekly investments and discuss things that I've learned, things to share, free insight, what's working, what isn't. So 25 years, I'm celebrating quarter of a century. Can you believe it? Well, of course you can believe it, because you can see from the picture back there, I had hair on my head. I no longer do. And I've got more double chins than I had then. Anyway, this is an extension of what I've been sharing, and I want you to know there's some pedigree to it. If you happen to be watching this on YouTube or TikTok a later date, please don't forget to do all of that. It keeps me relevant in my old age. Now, let's look at NVIDIA. It's in the news. One of the important things I want to teach you about this is why I don't particularly like analyst forecasts. Analyst forecasts tend unfailingly to be optimistic. You can see here the strong buys, 32, basically. Oh, and they tend to be wild in their disparity. So you've got the highest saying 200, the lowest analyst forecast saying 100, the average is 144, and the price is just below that. So, the current price is about 123, okay? Taking the average of the analyst forecast isn't really going to help you. Taking the median probably isn't going to help. It's too random. Okay, so I just wanted to teach you that when you look at analyst forecasts, because the forecasters have said this, let alone journalists and anybody else. It's just an important lesson, because we'll look at NVIDIA in more detail in just a second. But I think it's an important lesson that people sometimes forget. This is NVIDIA at the moment. That's where the price is, 123. Were it to fall after earnings, after market close, to this upward trend that it's had, you would see a 20% drop, which could easily happen in the stock. If you see it going to all-time highs, and I think it's going to do one of these two things, I don't gamble on earnings. I don't like to buy before earnings because it's a gamble. But were you to put a gun to my head, I'd probably say more likely to do that, the upside than the downside. However, you'd have to put a gun to my head for me to do it. I know it's undervalued, but the momentum is pretty high up there as things stand. I'm not going to gamble on it. Okay, so lesson number 2. Well, 1, don't listen to analysts because they're wild and erratic. Secondly, don't gamble around earnings. Okay, that's not what investing should be about. By the way, August over the last 20 years has been for NVIDIA one of the 81% of the time the price goes up in August. The stock is up this month, and it produces one of the best average returns that time as well. In fact, most months it's up. So there you go. Seasonality, past seasonality is not a guarantee of the future. Okay, so take it with a pinch of salt. And these are all the analysts. Goldman Sachs, buy. Is anybody ever going to dare to say no? Of course they're not going to say. I mean, I guess Deutsche Bank saying hold is something, but everybody else is saying buy. Like I said, don't go with the analysts. It just tends to be too variable. And if you don't believe me, I like to look at academic research. It's what I used to cover in my Financial Times columns. And here's a recent article on forecasting earnings and returns, a review of recent advancements. Bottom line, too many variables. It is a crapshoot and a gamble to try and follow earnings guesstimates and analysts' views. So don't do that. All right. These are the major problems people face. I don't know what to buy. These are the things we're going to discuss. We're going to get you moving away from the caffeinated hyper TV watching trading mentality to more the investing one. That's what this is about today. By the way, speaking of which, the Dow, 40% you think it'll be up, 40% down. God, you are really divided. So again, mixed in that. Now, I'm going to put another poll up. I've put Biden on this. He'll win the US election. For Biden, obviously read Kamala Harris, because Biden's not standing. So I've put the other poll up. Who do you think is going to win, Trump or Harris? Anyway, these are the things that I'm going to teach you how to do, and the stocks that meet my criteria and the ones that don't. I'm going to analyze them on this one. As you will know, I need value ticked. I need growth, earnings and revenue, dividend deals, share price to earnings, CROCI, cash return on capital invested, momentum in the right direction, Sortino, Alpha. These are all important. And then there's my magic sauce, which is my own sparkling personality and analysis on top of that. But I will only pick when all these boxes are ticked. Now, once I've got that, I might, and I'm going to explain this in this webinar, I might then in a tiebreaker, look at what the big gurus have got. For instance, the S&P 500, currently most number of guru holdings. This is your Warren Buffett's, your big hedge funds, your George Soros's and all the rest of it. I did in August happen to buy United Healthcare, not because the gurus have it, but because it hit my value growth income, Croaky, Sortino, Alpha, boxes, and on a tie break also happened to do this. Now I'll dive deeper into all of this in this webinar, but just so you know, and you can see which ones are popular with these so-called gurus, everything PayPal, ExxonMobil, Adobe, JP Morgan, Broadcom, Comcast, oh crap, what's KView? I've forgotten. Facebook, Citibank, Microsoft, Apple, Amazon. We should do a little bingo competition where I give you a ticker symbol, you shout out the name of the company and see who wins. That'd be a good pub quiz, wouldn't it, for geeks? Right. I might do a tie break on analyst projections. Now, I said they're useless, but it's a tie break. It's not it's a sort of like a coin toss. Which one should we go with? There's two stocks to choose from. They meet all my criteria. Oh, let's go with red, not blue, for instance. Okay. So, for instance, might look at people who've had consistent success rate as analysts, high average returns, and this is real time. So you've got this guy who likes these, and you can see he has a pretty good record. So that could be a tiebreaker. Once I know, and I'm only interested in ones which are already on my list, okay, on my Excel spreadsheet. I might turn around to hedge fund projections, look at hedge fund managers who are producing, say, 48, 50%, 3 years annualized returns. I had to Domino's Pizza yesterday, actually. I shouldn't have done. And look at what their recent holdings were and what they've done. Only if it's a tiebreaker, i.e., if I happen to have Domino's or Walt Disney in my value growth income cash flow Sortino Alpha, then as a tiebreaker, I might say, oh, actually, there's a very good hedge fund manager who also has added to it recently. Tiebreaker, let's go with the ones that he's also got, which are on my list, okay? On there. But looking at gurus alone is going to be useless. And this is the mistake people make. I show them that and they say, oh my God, I'll just follow the gurus. No, it doesn't work like that, because if you just follow them, it's randomized, it's delayed, it's useful as a tiebreaker, like a coin toss is a tiebreaker, like rock, paper, scissors is, because I just explained that there isn't a high correlation between their data, because it tends to be out of date, or like the analysts who tend to be too positive and returns. That's why it's a tiebreaker. But most people, it's like a pet dog to bacon. It's like, forget everything else he said, let's just go follow that. And they get it wrong. It is a tiebreaker like a coin. I could show you a coin and say, listen, if you're not sure whether to get one of these two stocks, which have ticked value, growth, income, cash flow, Sortino, Alpha, then toss a coin. You might say, where the hell do I get a coin from? I really want a coin. That's how I'm going to make all my decisions now. So just be careful. You can also, this is out of date. So Cadence this one is out of date. The others weren't. This is a historic example. Just look at, again, as a tiebreaker hedge fund activity. I need some way of tie breaking. So in this webinar, I'm going to cover how I scan and then give you examples of live market updates, what I like, what I don't, what the market's doing as well. Monitor them frequently. If you like to look at your portfolio every day or every week, you're going to go insane. Follow the advice of Warren Buffett. It's an investment. Don't trade your investments. Okay. If you get panicky, it means you've overinvested or you've not picked companies that you should have done, because you shouldn't have panicked. Right. So it's as simple as that. Value, growth, income, momentum of the statistics, as I said, usually between 20 to 40 stocks, maybe as little as 15 sometimes, never more than 40, because there's a diminishing return that you'll get from having more than 40. It just won't give you any more mitigation in risk or volatility, but it will diminish your returns. Okay. Some cash and maybe some low volatility funds if I feel like it. So let's get into the market and where we are with it. Okay. And this is valuations. You're paying $27 for one expected dollar in future profits of Microsoft. Well, that's pretty expensive. Red is expensive. What's cheap at these? So why aren't the cheap ones going up and the red ones going down? Why is it the red ones have been the ones which have been doing well? The expensive ones? Well, because valuation is not the only thing that moves stock prices. And this is a good way of showing it. Growth is. for instance. Momentum is also relevant as well. So what has been moving stocks of late? There you go. That's the 0% line. There have been certain sectors which have done well. I don't gamble on sectors and say, oh, I'm only going to buy basic materials or let's rotate into this or that. But this gives me an explanation of what's going on in the markets. Utilities have been doing extraordinarily well, whereas industrials are a pretty mixed bag. What you can see here is also year-to-date a few outliers. Now, the outliers are few and far between. None of the outliers are held by the billionaires like your Soros or the gurus. So if that's the case, in any substantial amounts, the biggest gurus, okay? So if that's the case, how come the people with the most money and the most data, the most analysts, the cleverest people in the world and access to supercomputers aren't picking these in their portfolios? Well, the reason is if you could do that, you'd only pick one stock and that'd be the end of the story, wouldn't it? Usually, most portfolios will need some kind of a stop loss so you don't sink. Okay, they'll have some small losses, some small gains, which will cancel each other out, and then some outliers. 20% of your stocks will probably generate 80% of your returns in a given year, as a general rule. It's not a nine-cast rule. That's why you don't just have one pick, okay? It's another way of explaining that. Earnings calendar, S&P 500, any of these that are going to move the markets coming up that we can see? Yeah, this one, and that's it. That's the only one that's going to move the markets, okay? Nothing else is going to do it. Not even HP or Salesforce will move the markets. Only the NVIDIA earnings after market close. Why did I say today? That's weird. I don't know. My brain's just going all whizzy. Sorry, 28th of August, NVIDIA results. Don't know why I said today. Okay. Now, the past week, tons of green. My job is not to know which of these are going to go up. My job is to make sure, one, I don't make any stupid mistakes by ensuring I've picked undervalued growing companies with dividend deals and be in a position to take advantage if there's a wind. It's a bit like sort of trying to fly a kite. If there's wind and it picks up, at least I've got a kite that's in the air, it'll fly. My job is not to say, oh, now it's going to go up, now it's going to crash, now it's going to fall. I'm not a weather forecaster. It's to take advantage of opportunities when they come and not make stupid mistakes, like have a kite with holes in it. All right. So my portfolio, the companies that I pick, undervalued, high growth, good income, good cash flows, are kites without a hole. Most people either don't even have a kite, they don't even have exposure to any of this and can't do anything, or they have a kite with bloody holes in it, and then they wonder why when there's a good wind, their kite's not moving. All right. So that's another type of analogy. And you can see that's the past week alone. This is the past year. And you can see I'd be happy with my pension doing any of this. Obviously, 193% my pension would be great. So if I'm so clever, why didn't I just pick NVIDIA and nothing else? And we had NVIDIA from January 2023. I had no idea it was AI in January 2023. I thought it was still crypto graphics cards because when we looked at the financials, it ticked all the boxes. Had I known it was going to go up 193%, I would have gone to Ladbrokes and put all my money in that and nothing else. So why do we have more than one stock? Because we can't see into the future. We don't have a time machine or a crystal ball. Anyway, my job is to put myself in a position to have as many of these greens as possible. And occasionally, even with this many greens, you might end up with a CVS. Okay? You might end up with an ExxonMobil, which hardly does anything in the same period. It can still happen, right? So it is not, I'm just cleverer than everyone else. I can just see into the future or anything like that. Kenview. Yes, Kenview. It's not a household name, is it? Funnily enough. Hello from Oroville. Wow. You're in India, outside of Chennai, are you? Phenomenal. I've been to Oroville. Here we go. ETFs, 1 month performance. I'm not going to talk about them here. If you want to research them, please be my guest. Do have a look at, say, US large cap. Have a look at fixed income. Have a look at any of these, actually, that you wish. They could be interesting to research. So year to date, this is where we are. The S&P is up 17%. The NASDAQ's up 17%. Okay, that's what it is. Let's have a look at it over the past year in a second. Now, one thing I've got to remind you is this. Look at this. That is from February. If you got into the NASDAQ in February, you would have had a 0% return from February to August. Yet the NASDAQ's up 17%. Alpesh, I don't get it. February to August, 0% return, but the Nasdaq's up 17%. How does that work? That works because the market does four things, and this is what causes people to lose a fortune in their pensions, or get wrong-footed, or miss the boat, or get on the boat and get off the boat early. Okay, this is what happens. Yes, I know markets go up. That's the first thing that happens, but that's one of only three things. The second thing that happens is markets go sideways for a long time. So that's the second thing. The third thing that markets do is they go up and then you lose all your gains. That's the third thing that happens. And the fourth thing is they fall. Okay, so you've got a mixture of 1, 2, 3, and 4 happening in a 17% return. When 2, 3, or 4 happen, you jump off, you don't jump back in, you panic, you start trading your investments, you mess it up. People like myself and Warren Buffett, we tend to just stay a little bit calmer and have a bit more perspective because of our incredibly ancient old age. And we say, well, the ones will come around. Ones happen 25% of the time. Those moves happen 25% of the time. Okay? The ones, the moves up. 2, 3, and 4, although they can overlap, happen the majority of the time. So you can see how people are constantly wrong-footed, and they don't understand this is how prices move. By the way, this is my first column in the Financial Times, 1999, 11th of September, auspicious day or not. Bloody hell. Certainly everybody remembers it. 9/11, 1999. Buy US stocks. I'm selling all mine. So thank you, Uncle Sam, on my 25th anniversary. What I said there, not only are US transaction costs cheaper, American stocks outperform their UK counterparts. 1999. Who is that young man? Give him a column in the Financial Times. This is, by the way, the FTSE All-Share, the S&P, and the Nasdaq over the last 10 years. Now, of course, there'll be periods where the UK markets outperform US. Of course, there will be. But most years, certainly over the last quarter of a century, rolling 1 year periods, rolling 2 year, rolling 3 year, rolling 5 year, it's not the case. And over a period of time like this, let's take the last 15 years, the gap gets just bigger. That's the UK, 47% up, FTSE All-Share. The Nasdaq, the S&P 500 is 300%. The Nasdaq is 600%. You might say, well, that's not fair. You can't compare apples with oranges. Well, I want a bloody apple then. I want 600%. You take your 50% rise over 15 years in your pension. I'll take my 600% rise in mine. And that's just assuming that I did the same as the index. Okay. It's a hell of a lot easier to fly a kite in a windy place like Chicago than it is indoors in a cinema in London. In other words, if you're looking at the UK, it's going to be a lot harder to get returns than when you've got more to choose from. So it is not me who's been clever in getting returns. It's not me who was smart making this point. As I said in that article, it's just that I had a lot more stocks to choose from, so I could narrow it down and filter, as opposed to being racist and saying I'll only pick British companies. Seems a bit rude. This might be one of the reasons why people there focus on UK companies, is why there's more than £1 trillion of Muppet money costing savers billions. There's £1.5 trillion in cash stored in savings accounts spread across ISAs and current accounts, according to the Bank of England, and that's just in the UK, an amount equal to the combined value of all UK residential mortgages. Bloody hell. Well, of course there is, because they're thinking, well, bloody fund managers are a bit crap, aren't they? And you know they are. These are the funds that they go to in their pension, and they get absolutely screwed on. Look at the relative performance compared to the benchmark. Okay, St. James's Place, global quality. Well, not really, because you gave people 5.9% over 3 years, whereas your benchmark was 33% up. Okay, so you're pretty rubbish. Fidelity makes the rubbish headlines a lot. As I said, so St. James's 91 makes it. So does Bailey Gifford, Lion Trust, St. James's again, Jupiter, and so on. Piss poor return. I mean, these give you negative return. This one's great. 91 Global, minus 3%, and the market's up 33 over 3 years. Oh, okay. How do they hire these people out of university? I mean, how do you even get to keep a job where your benchmark goes up 33%, you're down 3.8%, and you get to charge people? You can't do that in any other profession. You can't be that rubbish in any other profession for that prolonged period of time and still get to keep your job and charge people for the privilege. It is amazing, the fund management business. So if you find that in life you're just rubbish at everything, please consider getting a job in retail fund management. They will hire you if you're rubbish at everything else. Okay. In fact, it's mandatory you're rubbish at everything else because they only want people who are rubbish. Value, growth, income. We're going to look at all of these. Croaky, Sortino, Alpha. Now, Sortino, for those who don't know, very simple. And I cheat when I pick stocks with high Sortino. It means their average return is high and the volatility to the downside is relatively low and they recover quickly. That's all it means. Alpha means when the market goes up, they go up more. When the market falls, they don't fall as far. Ideally, you want stocks which have high alpha and high Sortino. It doesn't guarantee the future. The past does not guarantee the future. My God, I've been punched in the face often enough to know and realize that from life. Okay, the past does not guarantee the future. Just look at the disappointments people have when they get married. Not me, by the way. The past does not guarantee the future. Okay, so that's where we are with those. In fact, the reason we want undervalued companies with high growth and high cash return on capital invested compared to low growth, low cash return on capital invested is the undervalued high growth companies. I mean, you tell me, what do you think they're going to do compared to overvalued low growth companies? You tell me, what do you think their stock price are like to? There will be exceptions. There will be some really rubbish company on the brink of bankruptcy. Somebody does a tweet or does a takeover bid and it goes up 100%. Of course, there'll be exceptions. But as a general rule, I don't want to be bottom fishing for exceptions. Okay, this is an illustration of what we do, how we do it, why we do it. But there's no guarantee. I'm going to say it again. Sadly, there isn't a guarantee. If there was, I'd pick one stock. This would be the shortest webinar on the planet. I'd just say, I'll just buy this and go away. Performance of high Sortino versus low Sortino. What happens is they might even give you the same return over 100 days. It's just that the low Sortino one will be more volatile. Okay, so we want stability. We don't just want a return. You need a return without throwing your guts up in fear and all the rest of it. Jose, what's your opinion on buying an ETF? I don't know XLK. Is that tech? I'll have to have a look. I can't remember the symbol off the top of my head. And holding for 5 years. Well, I guess if you hold the S&P 500 over 5 years, you should be pretty safe. But watch out for the 300% drop. I prefer doing it, and I'll show you how, having an exit strategy, which I can deploy a parachute if I have to jump out of the burning plane, which I have to deploy maybe once every 5 years, okay? Because that makes the returns far greater, and I'll show you what I mean in a second. So I don't mind you extending your holding period, but it'd be better if you had an extended holding period and a parachute, and I'll explain what the parachute is. Please remember this. Most people say they're this, 90% in stocks, the rest in cash. For cash, just read bonds, okay? They're not. They're usually this. And they're given this by their IFA or wealth manager. So they're given few stocks, sprayed and prayed. They get bond-like performance, which is relatively low, and then they wonder why they're underperforming. So they then think, oh, I must be more aggressive. No, this is probably where most people should roughly be as a general guess. If you're in your 30s, you'll be more aggressive. If you're in your 70s, you'll be more conservative, obviously. The point is, getting that cash holding right is important. It reduces volatility. Buying more stocks is not a clever way of reducing volatility once you've got between 20 to 40 stocks. And one fund will have about 100 stocks, okay, at least. So thinking that having lots of funds, which is what your IFA lied to you about, reducing volatility is just simply mathematically incorrect. Holding a completely different asset like cash will reduce volatility, okay, because stocks tend to be correlated to the downside when the markets fall. IFAs don't know this, right? Because the multiple choice test they get, they only have it, they can get 40% of it wrong and still advise you on your future. So just be warned, right? So I want to educate people so they can ask the right questions. These are the sectors which since the start of the year have done well. I don't gamble on individual sectors. I look at companies instead, but it happens to be communications, utilities, financials. Oh yeah, XLK, there you go, technology, I was right. Well, you can see tech, there you go. You might want to mix a few of these, my friend, who's looking to hold for 5 years. But they're correlated to the upside. They're correlated to the downside. Of course, the factors that I need ticking are, I need the momentum box tick, the value, the growth. I need stocks which are undervalued good growth, and a subset of subset. Remember when you did your maths at school and Venn diagrams? I need them to be in that little subset bullseye. Out of 10,000 companies, there'll only be about 100 I can select from. Because out of 10,000, there'll only be 100 which meet my stringent criteria. If there were more than that, I'd make my criteria more stringent, wouldn't I? It's like, okay, I don't know, Stanford University, we've only got 100 places and 10,000 applicants. Oh, I know, let's make our procedure stringent enough that we just clear the bar. Okay, it's as simple as that. Over the past year, what's the markets done? Well, they fell. Your gains became negative. You had 0% returns for ages. That's how your year kicked off. And yet you got a 34% return in your year. From August till November, December. From August till November or December, you were thinking, what a rubbish. What, I hate investing. It's just crap. Okay. 34% return, or 28 on the S&P 500, which is the 500 largest US companies. 500 largest. That's pretty much investing in the world. You might think, oh, it's just investing in America. No. America is by far and away the largest economy in the world. China comes second. Good luck if you want to try and risk your money on that one. Okay, if you can believe the numbers. FTSE 350 over the past month. These are the stocks which have done the most. S&P, that's what I want to get to. So we're pretty much at all-time highs on the S&P 500. However, my favorite way of looking at prices is the medium and longer term averages, which is measured by this thing called the MACD, and I've written about it in my 18-odd books, so I'm not going to go through it here. Oh, I'll give you a copy of the books. By the way, you think Kamala's going to win? Kamala Ben, as we call her in India. Let's share the file. So you've got the book. There you go. That book should be being shared with you right now, Investing Unplugged. And I discussed this in there amongst other things. It is a bit overbought. When was it last like that? It was last like that around here. So this is roughly where we are. We might get another baby bear. What's a baby bear? When the monthly MACD is rising, it means any falls are a baby bear and can be ignored. When the monthly MACD is falling, it means it's a mama bear. They're less frequent, and if you've put too much money in something, you might need clean underwear. But you shouldn't have to panic at a mama bear either, because you won't have overexposed yourself. Okay, so you can keep your underwear firmly intact. And occasionally, once in 5 years, you get a daddy bear where the MACD is high and falling and crosses its own moving average. That's when you want to hold cash. When daddy comes home, you want to get the hell out of there and not be caught with mama. Okay, so that's probably the best way in 25 years I found to keep calm and analyze the markets, which is why I didn't panic when others were throwing up and throwing themselves out of buildings recently when the markets fell there, because I said, well, it looks like a baby bear, which could become a mama, but I don't anticipate transitions ahead of time. It's an important lesson. Most people, when they first start investing, will take about the first 9 months, first year to just get a bit of experience and understand things and get to grips with it. It's a bit like learning to drive, okay? NASDAQ 100, similarly, whilst it is a baby bear, those recent falls, it is behaving like it was here. So be warned, it could be near its peak. The upside may well be limited and the downside might be more likely. So just be careful. FTSE 100 is sort of trudging along sideways, really, isn't it? The S&P 500 top 10 stocks over the past month. Any worth looking at? Oh, look, there's Kenvue again. We just mentioned it, didn't you? In the past, I've mentioned PayPal a lot. What else? Fortinet, Centene. Okay, so let's have a look at any of these which might look interesting. Actually, I did look at them before this and I put the charts up, and none of them look like ones I'd want to get into now because they all look overbought or too volatile. So I'm going to save you a lot of time and say I'm afraid out of any of those, not particularly interested. Apple, which I continue holding, as you will know. I think we've got a bit more room. There's no guarantees. There is no guarantee. Okay, but I continue holding it. Would I buy it today? Well, given what I said about the S&P, I guess if I didn't have it, I might, but I'd be well aware that it could just do very little to the upside. Okay, so it'd be a strategic. Amazon, I continue holding. You know how to interpret it. It's a bit like it was here. Might be going sideways for a while. It's fine. I continue holding it. I'll take the dividends. We are not here with these where they skyrocketed. Okay. But I continue holding my Microsoft as well. Would I buy more today? Well, no, because I'm a bit worried I can pick it up cheaper later. Like Warren Buffett, I love it when prices fall because it means I can pick up good companies or more of them at a lower price, knowing that they're going to go back up. I mean, you tell me, if this drops 25%, is that it? Is it never going to make an all-time high again? Of course it will. So if it drops 25%, I want to buy more because I know I'll get a 30% return in the future, and I can take a 30% return. Okay, Meta. Overbought. Would I buy more today? No, not really. I'm a bit worried. That's not to say it won't make highs again. It's just to say at the moment I won't buy more. Okay. Don't forget, on YouTube, I've got a bunch of stuff where I explain why pension fund managers are robbing people blind. I don't own Bank of America, but it is a stock market update, and that should be the direction of travel. But look, it's never that simple. Look at that drop. That caused a few people to actually throw up physically. They had to take diaries. Okay. You don't need to panic if you know it's a baby bear, as it was there, because it does this. Look. And if you did need to change your underwear because you had an accident when that happened, then it tells you that you put too much money into it. You overexposed yourself. Netflix is an 8. Now it's gone to all-time high. I said a couple of weeks ago, oh, you might want to sell out now. It's peaked because it's overbought, but it just keeps rising. And occasionally, when these MACDs make their all-time highs, they can keep going up and up and up, but that happens in a minority of cases, and it's not the point at which I would normally buy. I never bought this, by the way, as you will know if you've been following me. It's one I've just been tracking since this period when it had stellar earnings, and said all along, I've not bought it, but let's have a look. It looks like it's going to follow momentum, and it did. And it went from 400 to 700. Yeah, I should have bought it and leveraged it and bought nothing else. Could have retired next week. Walmart, whilst it is 7, 8, or 9, very good. It's got a similar problem. Might keep going up and up and up, but I'm worried about the momentum. Berkshire Hathaway, overbought as well. I rather prefer buying things when their pattern looks like this, i.e. at these levels, than at these, I'm afraid. And I like a good night's sleep. Eli Lilly, similarly. And Eli Lilly will one day come back to this kind of level there. Not that price point necessarily, but the moving average will come, and then we'll get back in. And that's fine. Walt Disney, a bit of a disappointment. Just got to wait. It's a bit of a mama bear. We'll wait for it to do that. And again, an important lesson. If you don't like volatility, don't have stocks which are volatile. Similar with CVS. Just got to wait the game out. Block, you're waiting. A lot of investing is waiting. You're just waiting for that. And that's why we say 12 months, not 12-minute holdings. You're just waiting, bit of a support. If you don't like volatility, don't get stocks which in previous upward trends have had drawdowns of a certain depth and duration, which you don't like. Drawdown, depth, and duration is your risk. You can project forward previous angles of inclination of growth, move them forward, and say in 12 months, is that the kind of return that I would like? If it hits your 40%, then buy it. If it doesn't, then don't. Okay? With those. Okay? So I also want you to have a look at this campaign for $1 million, because it's got a lot of free resources there. You all think that Trump's going to win. Now let's have a look. Let's have a look at... Whoops. I want to do this poll. Start another poll. Let's have a look at the biggest mistakes people make amongst investors, see how you can avoid making them, and ask me any questions as I do this. First of all, not doing proper but quick, obvious analysis. If you cross the road without looking both sides, you're going to get run over, and you'll have gotten to the other side by pure luck. Similarly, if you don't look at all relevant information like valuation, like growth, and only pick companies which tick all those boxes, doesn't mean you can't pick a winner by pure chance on a dartboard, but you're relying too much on luck, and that's not a good way of treating your pension. So momentum, trend, statistics, I've discussed. I really want volatility in a stock to be below 20%. I don't like volatility, okay? And you might do tiebreakers like analysts and so on, but I need revenue growth, profit growth. I want them to be undervalued, generating income. So let's have a look at some of those things, i.e. people don't look at enough information. They also don't know when to hold and when to sell. Like I said, if it's a baby bear rising monthly MACD, then I can ignore any falls. If it's a mama bear, I can ignore it unless I did some kind of leverage position. Don't do leverage. I'm an expert. I can do it. You can't. Okay. Then I would ignore even mama bears, and daddy bears I don't ignore. And I tend to get out of any holding when it is overbought. What does overbought mean? It means when you draw this, it's in the top third of that graph. Okay. Falling at a steep angle, crossing clearly below its own moving average, suggests to me, get the hell out of there. And we did that in 2022, and we had to hold cash most of the year. And that saved us a fortune because cash was the best thing to have held. Okay. And that was worked out a treat. Now, I should put here, past performance is no guarantee of the future at all. And let us assume I'll never have a 54% return year again. So why do we do value, growth, income, cash flow, Sortino, alpha? Because a minority of the companies will do these kinds of returns. They'll do 208%, 137, 135. But the rest will be mediocre, which is why 208% from one company becomes on average 54%. Okay? There is no guarantee that will ever happen again. I know I'm stating the obvious, but I thought it's worth stating the obvious because some people might think, oh, what witchcraft is this? So if I knew Crocs was going to do 208%, I would have picked that and nothing else. But the reason we go to all this trouble of value, growth, income, cash flow, Sortino is because if we can get a few of the outliers, then that will raise the average and we'll do rather well. We'll still have some which lose money. We'll still have some which make small losses. We'll still have some which make small wins and won't go up. Why? Well, same reason Warren Buffett. Otherwise, we'd just pick one stock. Okay. Mistake number 4, not having an exit plan. For me, it's 12 months and then you reevaluate. Or if it drops 25% from the high point or from when you bought it. There's a subtlety to that, which I won't go into at the moment, but roughly that number and 12 months are the two most important numbers. This is from a fund manager called 91. Please be careful. They charge you 10%. Contrary to what you think, you're not being charged 1%. You're being charged 10% on £10,000 over a 5-year period. Okay. Over 5 years, 10% is what you're being charged on 10 grand. And this image has been taken from that fund manager and it's on page 47 of their PDF or some such thing where they hide it incredibly well. So please be careful. On the polls, it says only one of you's voted, I think. Well, everybody's voted for one thing, which is the number one frustration with fund managers about underperformance seems to be the reason. So I'm going to tell you why they underperform. And here's an email that I received from someone who had experienced this as well. This person's own pension provided by Legal and General. So check your pension, what it's invested in. Ask HR. Provided by my employer. The information was shocking. 20% growth between 2012 and 2022. 20%. Not per annum, in total. Okay. And the reason fund managers underperform is they spray and pray into a lot of other funds. So they've got multiple costs. They put too little money into good companies because they're so rubbish at picking companies that they dare not pick only a few. So they put it into 100 stocks, praying that one of those might be good and giving them enough marketing literature for the subsequent month in their monthly newsletter. And they also can't go into cash in years like 2022. So they get dragged down 25, 30%, which really hurts. Mathematically, one bad year like that will kill you. But they have to go, they can't go into cash because fund managers are not allowed to. And an IFA will say, no, I could always advise my clients to hold cash in a year like 2022. It just so happened I never have done so. Yeah, because they're not going to get paid their bloody fees. So they'll tell you they can do it and their financial planners and all this. You decide when you're picking a stock if the trend forward for a 40% increase in its price is realistic. For us, it happens if there is a massive market tailwind like in 2021, 2023, might never, ever happen again. I assume it will never happen again. If it's high Sortino stocks, remember those with high average returns, can't guarantee they'll continue in the future. Low volatility downside, high alpha, not UK, I'm afraid, not emerging markets. You just don't have enough of them with a tailwind. There isn't enough of a wind. Okay, 10,000 companies we go through. If you can go to cash in bad years like 2022, otherwise you can't get good returns because you'll give all your money up in the bad years. If you monitor once a fortnight, not every bloody second, because otherwise you'll end up trading because you'll see going 0% for 5 months in 12 and you'll go, I'm getting out. If good years make up for bad, croaky stocks, that's Goldman Sachs's measure, 30% per annum is what those stocks do. And I'll explain croaky in just a second. Hold for 12 months, not for 12 minutes, not for 12 years. 12 months is a good benchmark, and 25% is a good stop loss. Okay. For us, that meant last year looked like this. This may never happen again. This is no guarantee of the future at all. Stock markets might fall forevermore. All right. I have to state the obvious. And you might say, well, wait a minute. If you got these based on your criteria, then how come all these aren't green? Because by the end of the year, none of these should be green, because the stock should be so overvalued because it's gone up so much, it's overvalued, and all the growth has been factored in, et cetera, and it's investing so much money, it's generating hardly any cash because it's invested so much, blah, 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 blah. But the returns over 12 months were these. Okay, well, why the disparity? Well, that's the point I'm making. If I knew that NVIDIA would go up, I would have just put all my money in that and nothing else. And Meta. You might say, well, I knew that, Alpesh. Well, good luck to you. You probably bought Bitcoin as well in 1876. Well done. Okay. And how come using the same approach, you can have a stock which is negative and one which is up 238%, which just shows you that the same criteria, whilst it will remove a lot of bad companies, will give rise to a massive disparity in performance because companies perform differently. Okay. And that's what gave an 80%. That will never happen again. Because if that happened again and again and again, I would be probably dunked in the river for witchcraft. Okay. So past performance, no guarantee of the future, but that's why we go to all this trouble. Because if I get that, let's say I just get that this year. Okay. Or last year, rather. That happened last year. And I never get anything more than a mediocre bank interest rate return for the rest of my life. Well, at least my pension went up 80% and then is compounding at the higher amount. Okay, nearly doubled in 1 year. I'm not saying it's going to double every year. It's not, because I'd be a trillionaire. That was an exceptional year. We need to be in a position to take advantage of those exceptional years when they happen by value, growth, income, cash flow, Sortino. Put another way, over 10 years, if you can get some great years and some mediocre years, okay, and it comes to, say, even 20%. By the way, 15% per annum is the S&P 500 over the last 10 years in sterling terms. So you're only looking at a marginal increase on that. You start with 100, you add a bit in each month, you should get $1 million after 10 years. Every 100 should turn into $1 million over 10 years. It'll look like this, except it won't. Because what will happen is you'll get a great year, then a bad year, then probably a great year, then a mediocre year, then a great year, and then not so great, then down, then up, and then down, and then up. And so it'll probably look something like that as a rough guess. Okay. But what you're trying to do after 10 years is get to a point where every year you're getting about $100,000 in passive income. That's obviously the game. And it doesn't happen in just a year. In fact, in the first year, it looks like, what's the point? Like anything worthwhile, the first year of anything looks like, what's the bloody point? Okay, don't worry about that one. My whole philosophy has always been, from the time I won the competition in the Financial Times and set up the hedge fund in 2004 off the back of the publicity of it, has always been private investors can be better than fund managers. Okay, private investors can be better than fund managers. The poll doesn't seem to come through today. Sorry about that. Let me reset the poll and try it again. That's weird. Might be just people's settings. I thought it wasn't coming through because it sort of was an odd, it looked like only a couple of people had seen it, and yet we've got quite a few on the program. Let's go. Okay, so I've reset the poll. If it doesn't come through, sorry, apologies. Are they allowed to invest in US stocks? Yes, in your SIP and ISA, you can buy US stocks. Notice that SPX, when monthly MACD crosses the signal line, buying it when crosses again, it usually around a similar price. Is there a better way to buy and sell? Thanks all. No, I'm not sure entirely what you mean. Do let me know. So that's not the only thing. I won competitions on Channel 4 and Bloomberg. It's not me. It is value, growth, income, cash flow, Sortino. That's what it is. This Muppet raised £9.2 billion and didn't beat Jasper. Well, beat Jasper the cat. Just. Okay? Jasper the cat was the editor's cat that picked random numbers from the floor. They'll build you up. They'll knock you down every single time. I generally pick about 20 stocks because as you increase, you don't reduce market risk. The only way to remove market risk is to have cash, like in 2022. once in 5 years, you've got to be in a position to hold cash when it's a daddy bear, as I explained. So for those of you who want ETFs over a 5-year period, that's all well and good. Please have the parachute, which is if it becomes a daddy bear, get out of that. Okay. I think I made the books available as well. I've written many more, but this is the one I made available here for you on the platform. Okay. Now, Croaky is really important to me, and it's one of the secret sources. This is a slide from Goldman Sachs, their quantum database. Okay, and what Croaky is cash return on capital invested. That's total capital. Let's say you buy a machine that prints money. Well, that's your cash return on capital invested. Companies in the top 25% generate 30% per annum stock price performance. 30% per annum stock price performance. Not every company in the top 25% by Croaky, not every year. Like the financial crisis, none of them did. Although last year, bloody hell, it blew the doors off. So it's a thing I need to tick. I need to tick because I like to make money. Okay, this is a typical portfolio of somebody who writes into me. Too many funds, too many poor funds, too many stocks which have not enough greens, so the performance on them is rubbish. This is at the time he sent me this. Okay, might have got worse since then. But you can see too many stocks. Scottish Mortgage Investment Trust was down in 2022, 50%. So ask your IFL wealth manager, what would you have done in 2022 and how did you perform? Did you tell anybody to go into cash? How much money did you lose? Because why didn't they go into cash? How come they didn't know? Maybe not in January, maybe by February or March or April or May. Yeah, there's 12 months in a bloody year, 365 days to make that decision, and they didn't. Brewin Dolphin, another one where people write to me and complain about it. Stock spread over 1,000 different companies in a scattergun effect. If they start doing that, or Fisher Investments, oh, we'll just put you into our fund. They'll do loads of adverts just to shove you into their fund because they know this is just money. Ken Fisher once famously said, asset management is 80% marketing. Oh, yeah, he knows it. Oh, yeah, they've got an amazing model. Just market to their funds. The problem with being in a fund and why I wouldn't have a retail fund myself is I'd have a conflict of interest with you. I couldn't tell you 2022, get out of my fund and hold cash. And my fund wouldn't be allowed to hold cash because you're not allowed. You're allowed to hold, I think, maximum 2% in cash in most funds because you can't charge people for holding their money. You've got to pay them money. That's what banks do. You can't just say, I'm going to be an opposite of a bank. Give me your money, I'll hold cash. It'd be seen very naughty. Let me show you what my plans are for a stock exchange listing that I've got planned. That's the holy grail. Value, growth, income, cash flow, Sortino, the whole lot. Thank you, Bert. Reading sorted for the weekend. Good. No, kid. 25% isn't related to Fibonacci, but it's a nice coincidence. Randomly it crossed its signal line for the S&P in February 2022 at around 4,500. When it crossed again, signals around 4,400. Given the summarizing prices, is there a better way to use the MAD? No, that's fine. I just use it that way. This was some of the people in my team who joined me out of university, like Kirsty or Naomi. They all went on to financial services. The point is, these two are English literature students. Worked for me for 2 years, both of them. I think Kirsty a bit longer. One's now a fund manager. The other one's a pension solicitor. My point being, anybody can learn this stuff. Even if you've only done English and have no background in finance, it is not complicated. Actually, with Kirsty, I used to tell her, make me a case for buying a stock. And she picked it up in about 5 minutes. Okay. It's pretty straightforward. It is not the rocket science people tell you it is. Okay. So please make sure that you follow the things that I've said. The ideal thing, of course, is this. This is what we were looking to do. We thought, how can we upend the asset management business? We thought the best way to upend the asset management business is not to own people's assets, not to say we'll create a fund and then have a conflict of interest with you, not be able to go into cash, spray and pray, lots of stocks in companies which we can't easily get out of because we've got billions under management. Instead, we'll do what Airbnb do. They're a property company without owning properties, or Uber, they're a taxi company without owning cars. Well, what if you could be an asset management company without owning the assets? What if you own the assets? What if you were given the data and the knowledge and you pick the stocks yourself? Then you'd be like an Uber or an Airbnb and be a billion-dollar asset management company and disrupt the industry which is pretty easy and ready to disrupt. Okay. These are some of the lovely people who've been kind enough to give lots of wonderful reviews on my work. So we thought, well, why don't we do this? Whilst we're in the alternative asset management business, which is private equity, venture capital, and hedge funds, which is not open to retail, why don't we, as a side hustle, side project, side gig, whatever the kids call it nowadays, make the data available, make the education available so people know how to use it, and then they run their own fund manager, their own asset manager, and they can keep their own fees. So they don't have to pay anything every day, every week, every month. That's my ambition. That's what we've been working on the side while I do all my other stuff. And I love it because, well, the people love it. And we've done a whole load of video interviews with people who love it. And you'll probably know about the program already anyway, a Great Investments Program, I call it. And that's my ambition, to turn the asset management business on its head. We won't get 100% market share, but even if we get a dent into St. James's Place's 900,000 clients who are really unhappy with it, sorry, two are happy with it, 899,998 clients who are unhappy with St. James's Place, that's a lot to pick from. Okay, even if we get 1,000 of those, and that was a FTSE 100 company. Okay, and the conflicts of interest are screaming loud, which is, they will send you to a load of funds they get kickbacks from. The funds will not be able to hold cash in years when they should. They'll drag your performance low. And by spraying and praying amongst a whole load of companies, they will end up underperforming benchmarks, as I've already shown. Wouldn't you rather control your own money through a SIP or ISA? It's as simple as that. If you want to be part of that and have the data, and there's no ongoing charges, I should say, if you'd like all of that, the education, the data, and the information, so you're in charge of your portfolio yourself, and handheld for life, then that's my ambition. We want to, well, we're already gone global because we've got people from around the world. But the main ideas are, you get all the data, but also you get the one-to-one holding with me. I've marked those in yellow because those are the things that people really, really, really want. Okay, those are the two things that people truly want. They want the access and education to me, which are going to stand for life, and they want the returns. Obviously, there is no guarantee of future returns. Obviously, there's no guarantee. I wish I could. Markets can rise and fall, and all the rest of it has to be taken seriously as well. If you look at the S&P, I think somebody asked me about the S&P. If we get tailwinds, i.e. the years when it's rising, our portfolio should do incredibly better. If we get headwinds like 2022, and you can see when it crossed below, the S&P was at 4,500. When it crossed back above, it was at 42. But you missed most of the, you don't have to wait for the cross. As long as it's not falling, then you can enter into your other stocks, not necessarily the S&P, into your other stocks. What you're trying to do is avoid as much of this. You'll never get the top and bottom of that 26% drop as much as possible. Now, if you only avoided, let's say, from there to when this stops falling to there, 15% or 9% or 10% of it, that is a big amount to avoid in the drops. Okay, if you avoided even 10%, it's certainly avoiding a lot. Those years are rare, and I want to hold cash in those. You might say, no, surely, who cares? Because it's not about the S&P. I'll tell you what it's about. It's about the likes of these stocks. That's what people don't get. If you look at this, Meta, and it's a good example because it actually happened. When we said to go into cash, okay, we didn't know it was going to drop 73%. When we said when the MACD stopped falling and it was rising in January of last year to get back in, we didn't know from there till now it's going to go up 300%. Okay, or even just, let's just take it to the start of this year, 165%. Didn't know it was going to go up that much. All we knew was on a daddy bear to want to hold it when it's falling, and when the MACD stops falling, starts rising, don't mind. Individual stocks will have greater volatility to the downside and the upside than the index as a whole. Those are the ones where you've got to try and avoid as much of these falls as possible. That's why Scottish Mortgage fell 50% in 2022. That's why avoiding 2022 is incredibly, incredibly important. The rest of the time, we're all geniuses because we didn't invent Meta, but we could just sit in. We can just sit in and watch it forever. Okay, I'm just press the wrong damn thing. We can just sit in and watch the damn thing and make 190 or whatever. Okay. Avoiding that and going into cash is so important. It's those little things that make a big difference. And you only need to do it once in 7 years, usually. No guarantee that'll be the case in the future. If I can get on a 500,000, let's say, a 20% year, then that's 100K. That year, that's the maths of it. There's no guarantee that would ever happen again. If we can do that more than once, even better. But even if we only do that once and we get an outsized return, hey, the compounding effect and then mediocrity all the time, not that we're aiming for mediocrity. And there's no guarantee it could happen again. Let's assume it will never happen again. But my point is, even if that happens once in the next 5 years, then that'll be fine. And all the other years are just average index tracking. Okay? Then it's fine. Anyway, if you'd like to learn, if you would like the data, if you would like to be part of that whole journey, my ambition is once we get to, originally it was going to be 250, I'll probably ramp it up to 350 initial charter members, as it were, who will only have the one-off payment and have me for life. Then after that, we'll expand it globally, get some venture capital investment, float it. That's the whole idea. To do that. That's what I'd like to do. I'm not in a mad rush to do any of that, but to do that. Thank you for this content and weekly updates. I've been following you since I graduated. Delighted. Fantastic. I am delighted. Thank you, Bavik. Devak. Thank you, Devak. Thank you. Appreciate it very much. Very kind of you. Okay, so have a look at that. I'm going to send you some more. Oops. Let's look at the poll. Yeah, these are the major things people have said. Underperformance, not trustworthy. Yeah, lack of information education. That's why we have a whole information program on there. Lack of transparency. That's why we give you all the data. Okay, every single thing you've said there, right, we've tried to improve upon. That's how you shake up an industry. That is how you shake up an industry. You say you're not going to get charged fees. Okay, that's the program. We're going to give you all the data. Think of yourself as the head of your own family office and think of me as me and my team as working for you, and we're Goldman Sachs or we're McKinsey, and we give you all the data and you say, well, that's just data, I need to understand it. So we give you the education, then we give you the summary of the ones which we think meet that criteria, and you say, well, I need to understand it, I need the data, I need the summary, and we'll give you all three, and you go, oh, right, I get it now. And then you say, well, I want to have a chat with you. One of my clients I had a talk with at midnight in Bali. I was in Bali 2 weeks ago, and my sister was out there, said, why are you having a client call at midnight Bali time? I said, well, I love this stuff, and I haven't talked to anybody about the markets for about a week, so I'm going to speak to this guy for an hour, and he's going to think I'm doing him a favor, but I'm loving it because I'm doing myself a favor. I love the markets. So we have a team around the world, a data team who collates all the data. We have a graphics team who puts all the lovely pictures together. Myself and a vice president, as it were. So if I get assassinated and fall under a bus, my vice president takes over because it's a company, and you'll continue getting the data. And all the education material, myself cloned online, so all my videos. So even if I fell under a bus tomorrow, it wouldn't be a problem because you would be able to see all of that straight away. Glenn, thank you. Excellent as always. Do you ever do live events? I have thought about a 2-day crash course again. Because we did one in Spain, and I was looking at locations in both Bali and Maldives earlier in the year for one. Probably do one outside of London, I think, maybe in Windsor. But I'm looking at it. Yeah, if people say, yeah, I'd be interested in a crash course, Alpesh, then I may well do another one. As always with those, for people who've been on the Spanish one, they'll get free access for life to any of my future ones. So, yeah, I thought about that. And, yeah, I think if we get a lot of people interested, then I think I will. Love Windsor, fantastic. Maybe it'll be Windsor then. We'll do it in a way where, people don't have to stay in the hotel. They can just stay wherever they want. These are the main problems with fund managers, IFAs. I mean, IFAs are the worst because, seriously, they don't have any of this. All they're doing is getting kickbacks for selling you funds. Fund managers are saying to them, we'll give you a kickback to an IFA if you sell this fund. I mean, it's just awful. I do villas in Bali, as you know, Alpesh. Oh, gee, yeah, I completely forgot. You told me, and I forgot. And I'm back now. I've completely forgot. I ended up staying just regular hotels. You did tell me, and it totally slipped my mind. That would have been nice, actually. I was in Ubud. Windsor would be good, Derek. Okay, look, let me look at them Windsor and look at a 2-day one and see what happens. Okay, let's do that. Let me see about that. 2-day options training in Heathrow, which was great value. Oh, fantastic. Okay, do send me the details of the one you went. I'll try and mimic the same sort of pricing and maybe even the same hotel. I assume they did it near Heathrow because it's convenient. The hotels are big and it's cheaper. I've been to some of those hotels near Heathrow. They're very convenient for people, I think. Or you can rent a car, and the car rentals just across the road and so on. So, yeah, I'll do that. Well, quite a few of you have said yes, so maybe I'll do the ones in person over 2 days. Probably do it alongside Paresh, because me speaking for 2 days will kill my throat. But we really had a good time in Malaga when we did it in Spain, and it went really well. Please have a look at the campaign for $1 million as well. And if you want to join the program, as some of you have, then it's alpeshpatel.com/shares. More than happy to welcome you on board. Sheraton. Yes, that's definitely one of the ones. Okay, I'll have a look at that and look at that and Windsor as alternatives for it. More than happy to do that. I was also looking at Richmond in West London as well. Just things which will be accessible to people, really. So thank you all very much. Any other questions I can answer, let me know. I'm going to go through the slides in reverse order because I find it sometimes triggers people's questions and so on. Taster, 2K-ish, understood, Glyn. I'll try and keep it to the same mark, basically. I mean, as long as it covers the hotel costs. I don't look at them as some kind of cash cow just because unless you're Anthony Robbins size, you just, or Taylor Swift, it's better just to do it because you enjoy it and you want to meet people and do it because you unless you can market to gazillion people, you tend to get a handful of people, which keeps it small and intimate anyway. So as long as it washes its face and covers all the food and costs and the accommodation, not accommodation, but you know what I mean. And even food you don't really need to cover. If people just want to go and have during the break times, bring their own sandwiches and stuff, you can keep the costs even lower for those. But yeah, I would do it because I wanted to do it. And, a bit like when you don't want to liken myself to a Hollywood superstar, but then when those Hollywood film stars do theatre in the West End, you think, what the hell? He's an A-list actor. Why is he doing the theatre? Because they love it. That's why. It's the only reason you do it. You certainly don't get paid 20 million as you do in a movie to then appear in the West End. So I think I'd do it on that basis because the only basis on which to do it, like I said, unless you're Taylor Swift in a live performance, which I am not, contrary to what you might think. Okay, so just reversing through these in reverse order. Okay, I'm going to leave it at that then. Thank you all very much. And everyone who's joined, thank you for that as well. And you'll get an email from me in a second. Do follow me on LinkedIn as well. I will see if there's any other files to send. Oh, I can send a few others, actually. There we go. You can have all of those. Thank you all very much. So thanks. Any other questions after this, just message me and I'll put a load on TikTok anyway. Glad to be back into the whole swing of things once again. Thank you all. I will see you soon. Have a good break. I guess we're all still on a break. Thank you.